Very good evening, one and all. It is 6:30 on Wednesday, the 15th of January, 2025. A whole new investing year is ahead of us. Hello from me, Anthony Clark, sitting here in my home office in Cape Town. For those that follow me on social media, Small Talk Daily, I've been in the last 2 weeks in the Swartland with a dog, remote working, and I'm also leaving tomorrow to go to a beach house, which I'm working on the other side of Hermanus. The joy of COVID and the joy of my type of work is you can work anywhere because information tends to follow me. So once again, I've got my trusty glass of water, and it's not neat gin, contrary to popular opinion. So what I'm going to be doing in the course of the next hour, this is going to be quite an action-packed session, the first one of the year on behalf of Rand Swiss. And as always, I'd like to thank Gary Boysons and his entire team at Rand Swiss. As you all know, they are the country's leading private client stockbroker. They asked me to do this webinar, and I'm very happy to engage with them. And given that this time last year, I detailed my top stocks of 2024, which for those that followed the entire list of the 9, was up 52.48% for the year, which is significantly ahead of the benchmarks, which I'll come to later. In the course of the next 59 minutes, because I don't want Pascal, who's recording this at Rand Swiss, to miss her supper, is I'm going to run through the performance briefly of the stocks of last year and the key touch points and my current view on all 9 stocks. And then I'm going to give a quick preamble as to why I selected the stocks for 2025, and then briefly run through all 10 stocks. And then hopefully, if there is time, which I highly doubt, given there's a lot to get through in this session, there's some 18 or 19 companies in total. I will take Q&A if there's time. If not, we'll have to save that to the next session. So to start off, this time last year, I literally issued the top 9 of 2024. In order, they were Afrimat, Argent Industrial, Astral Foods, Kuro Holdings, KAL Group, which was formerly Carp Agri, Libstar, Novus Holdings, Premier Foods, and Roynat. That selection, as I mentioned, was up 52.48% at point of selection to the end of December 2024. And that compares to my benchmarks, which is the ALSI, which is up 12.9%, again from a point of selection. The mid-cap index up 15.17%. And then the small cap sector was a place to be last year, the J202. That was up 30.99%, showing you that my top 9 had a significant outperformance of all the key benchmarks, but particularly the mid-cap index, where most of my counters chosen last year were in the mid-cap arena. The best performing stock of last year was Premier, which was up, including dividends, 123% in round numbers. And the worst performing stock, if there is such a thing as a worst performing stock, because it still beat the benchmark, was Kuro Holdings, up 15.66%. The second best holding was Novus, which is up, where are we here? 89%. And then just behind it was Argent Industrial, up about 88% in round numbers. But most of the stocks were up in the mid-30s, which was Astral Foods, KAL Group, Roynat, and Libstar, with many of the stocks actually attaining and exceeding the price targets that I set myself. So briefly running through, as a reminder, when I do this competition for myself and my institutional clients, the rationale of this competition is, one, to try and work through the universe of stocks that I cover, which is roughly 70 companies, and pick the ones which I feel in my universe will outperform the key indices. So whilst many of the stocks have had better performances, particularly in the resources sector, in certain counters and in financial services, I don't cover those stocks. So the stocks selected are only from the universe that I cover in small to mid-cap financial and industrial companies, the J357 food producer sector, and of course the agricultural sector. So there are many, many stocks in the JSE which I don't cover, over 280, but I do cover around 70, which is enough for one analyst to cover to give them wrinkles and some grey hair. So During the course of a year, my selection is cast in stone. I cannot change any recommendation once it is selected at the start of a year. But in my normal course of my works, in the institutional work that I do, recommendations do change. Excuse me. For example, I chose Afrimat at the beginning of last year, and it had a really, really great run up until about the middle of July. And then it was clearly evident to me, given the turnover in the iron ore price, which was rolling off its high, and there was some softness in the domestic market in the mining and industrial area, and of course the delay in the implementation of the Lafarge transaction, which Afrimat did the year previously. They were not going to have a great results period to August 2024. So I changed my recommendation at 71 Rand 58, moving the stock from a buy back to a short-term sell, expecting the stock to fall back to about 60 Rand. It got back to 63, and then I promptly changed my recommendation from a 63 back to a buy with an accumulate, and the stock ended up back at 70 Rand. But again, in the course of my recommendations for my competition, I have to stick with recommendations. That is one example. Why did Premier Group, for example, rise 123% year to date? That was a fairly interesting choice. I chose that company because, having covered the soft commodity sector very, very closely, and the wheat price internationally was on the downtrend, I believe that milling and baking companies would have what I would call muted input prices and the ability to raise their prices to the consumer, because bread is a basic staple. With the ending of load shedding and the diesel price having come down 5 Rand a litre last year, and energy and fuel costs are major factors in milling and baking companies, the operational leverage that I saw to Premier's profits was clearly evident for me to see. And I put a buy in the stock at 62 Rand. And it quickly ran up after the Brait placement in March. And then by September, it hit 78. And in early September, again, in chatting to the company, it was clearly evident that the company was going to have really good earnings for their September year end. And I gained this from actually listening into annual general meetings. I think anyone that has persistently listened to my webinars will realize how much sway I put in listening into AGMs. No one ever bothers, and you can question management as often as you like at AGMs, and they generally give you very interesting answers, because an AGM is a public forum. If you're the only person to actually get off your ass and actually participate, then you have the information to yourself. So all of these critiques that I get that AGMs is privileged information is complete bunkum. An AGM, once a quorum is given, is a public forum. If you're the only one there, you have the information to yourself. And if there are other people there, then you get to share it. So Premier to me was a fantastic story, and the information was all there to see. And other counters which performed extremely well, like Libstar, was there on a combination of debt restructuring, a simplification of the structure, and I thought some corporate activity. And I had a 4 Rand 50 price target on Libstar when it was chosen at 3 Rand 30, and it actually went to 5 Rand. And towards the end of the year, it came back down, but my target was actually made. So as it stands right now, on the 6th of January, I wrote quite a lengthy document, which again, Rand Swiss clients will have received, indicating what happened to each stock last year and which companies would I want to keep on owning into 2025. So briefly, I've still got Afrimat as an accumulate. I've got Argent as a hold. I've got Astral Foods as a hold because it's had a good run. I've got Curro Holdings also back to a hold. I've actually increased Advotech to my #1 education pick, and Curro is now #3. I've got KAL Group as a buy. That's rolled over into my 2025 selection for the 3rd consecutive year. I've never had a stock for 3 consecutive years, but in 2023, the stock was up in the mid-30s. It was also up in the mid-30s in 2024, and I'm hoping that 2025 will be a kind year for me too. Libstar, I've pulled back to a hold. I actually prefer RFG Group, which is Rhodes Foods Group, which is also a selection I have in 2025. I still believe there'll be corporate activity during the course of the year in Libstar as the private equity company's fund, which is the dominant shareholder in that company, has to sell its stake or at least roll it over. Premier Foods I've brought back to a hold because the stock, having run 123%, the easy money has been made. And even though I see extremely strong earnings growth in Premier for the next 2 consecutive years, which will unwind the PE, which is currently around an 18, it'll bring it back to probably about an 11 or a 12. I hate recommending a stock when the easy money has been made. So Premier right now is a hold. Novus Holdings again had a fantastic year. It's the second year the stock was in my portfolio, having had a very good 2023 period. But again, the easy money has been made. And I hate recommending stocks when you could have bought this thing a year or two ago at 4 Rand or less. And until the Mustech transaction, which Novus is currently involved in, is finalized, and the market knows exactly what is going on with Mustech and Novus, I think the stock will probably just trend sideways or drift slightly lower. Although I did see today that they've actually won their latest appeal case against Caxton, who was not very happy that Media24 sold their community newspapers to Novus and the on the dot distribution business. So once again, Novus has triumphed over Caxton. And then lastly was Roynat. Now, Roynat had a very, very good year for me last year. It was up just under 34%. But the share price ran quite nicely. And then when they had the results in November, it was clearly evident for those that follow Roynat that the share price had run away and the earnings were simply not there to match the share price. And once the earnings came out for the September year-end period in, I think, the 21st of November, and they're only up from memory around 10%, the market says, well, hang on, we've driven your share price up on a combination of factors, and the earnings are just not there. And the share price has fallen ever since. I think right now it's probably down to the early 70s. And I called a sell on Roynat in my normal works, just on results, saying I would probably buy it back at 70 or below. So that's the round robin wrap for the top stocks of 2024. I was very pleased with the overall performance. Some real stars, some stocks that I think that anyone would be pleased to own. But so if you do own Afrimat, Argent, Astral, Kuro, KAL Group, Libstar, Novus, Premier, and Roynat, there's nothing inherently wrong with any of those companies. If I had them in my portfolio, I certainly wouldn't be selling them. But as I said, I'm always reluctant to chase stocks where the easy money has been made. So of all of our stocks, which ones would I want to hold or want to own for a long-term 3 to 5 year growth portfolio? The answer, of course, would be Afrimat, Argent Industrial, KAL Group, Novus, and Premier. The rest would just fall by the wayside. Now, try and talk and remember all of these numbers and try and keep a throat lubricated is a hard task. I'll put aside my stocks for 2024, and I'm now going to move on to the stocks for 2025, given it's 1843. So a quick recap and roundup. Year to date, as I sit to discuss this selection with you, the Aussie year to date is down 2.34%. The mid-cap index is down 1.81%. And the small-cap index is down 4.67%, showing you that the outperformers of last year have become the underperformers of this year. And that's a combination of reasons. I think many of the stocks last year had a very, very good run. And I actually did a presentation with Michael Avery yesterday on Classic Business. And I stated that it was extremely difficult to try and choose this year's top stocks because many of the stocks I really wanted to select, particularly in my small cap universe, had a hell of a run. And again, I'm reluctant to choose stocks that have had, the easy money taken off the table. So when I put my list together in mid-December, and when I refined the list towards the end of December for selection in early January, I had to change a lot of my views because a lot of the easy money had been made. The other contentious factor the market is considering is what will be happening this year. We have a rand being very volatile. I've just written a piece on Oceania fishing, which went out a few hours ago to my clients. And since the 1st of November, The rand is 7.6% weaker against the dollar. We also have a different geopolitical climate with, President-elect Trump coming in to be sworn into office on the 20th of January. And no one knows what that gentleman, I shall be polite and call him a gentleman, even though he is a convicted felon and a consummate liar. Nobody knows what that gentleman is going to be doing regarding US trade policy, tariff policy, or his view on the world. Will he be going after Canada? Will he want Greenland? Will he want Panama? Will he pull out of NATO? Who the hell knows what that crazy gentleman is going to be doing? And all of this plays into geopolitics. And when I was selecting the stocks, I had to take that into account because I had to choose the stocks which I thought had a certain degree of resilience, where the underlying situations either had a degree of value in the selection or what I would call special situations. So as I gave the preamble to my radio interview yesterday, I said it would be criminal of me to try and estimate that my selection this year would trump last year's 52.48%, because the world is a much different place at the start of 2025 compared to where it was at the start of 2024. And then, as we all know, after the election in this country at the end of May and the eventual formation of government of national unity, which caused a huge relief rally in the stock market, particularly in the small cap sector, and we are in a declining interest rate environment. Some of the benefits we saw in the second half of last year are now beginning to unwind. The low oil price, which got to about $65, $66 a barrel, and a stronger rand. We now have a weaker rand at 18.79 to the dollar, and the oil price is trending towards $80 a barrel. And who knows what's going to happen, after Trump gets in. Despite his drill, baby, drill mantra, we've got geopolitics in the Middle East. Although I do see that there is a press conference coming out of Qatar in the next couple of hours. Hopefully there'll be a ceasefire agreement between Israel and Hamas in the Gaza region. We pray for peace and some sanity to prevail. But we also don't know what Mr. Putin will do, given his ongoing war in the Ukraine. So we have a very interesting 12 months ahead of us. And anyone who believes that geopolitics, as I do, has a sway to the stock market, then has to be quite concerned that the next 12 months will certainly not be as easy as the last 12 months. And as I said to Pascal coming onto this call, I've now had 3 successive years where my top stock selection has healthily beaten my benchmark indices. I think it'll be very tough this year, very, very tough. So the selection I've chosen hopefully will be quite resilient, and hopefully will lead to a 4th successive year of outperformance, but we shall see. So briefly running through what the top 10 stocks are. Someone said, why are you doing a top 10? Does your list get bigger every single year? So the answer is no. Top 9 sounds quite strange, and top 10 sounds a lot better. And if I had to whittle these stocks down, I thought, well, shall I just cut a few to have a top 5 or a top 6 or a top 7 or a top 8? But it was very difficult for me to actually cut stocks, because I actually think that every single one of them actually has an element of credibility, which I think could see every single one of them moving higher on a 12-month view. So unlike last year, where from day one, my top stock selection from January onwards consistently and healthily beat the benchmark indices. Year to date, in the first 15 days, this portfolio is actually down. It's still better than the small cap index and slightly better than the mid cap index, but it's not performing, it's not in positive territory. But at least I'm doing slightly better than my key benchmarks. So the top stocks are as follows, for those with pen and paper handy. Although, again, this document did go out to Rand Swiss clients fairly recently and to my institutional clients too. But this webinar was requested by Rand Swiss on the 15th. So I just fall in to their requirements, because most people were on holiday, getting back to their desks, and of course, probably looking after the children, given that school is about to resume too. So top stocks are as follows in alphabetical order. Drum roll, please. It's Advotech, Cashbuilt, Combined Motor Holdings, or CMH, Grindrod, Hoskins Consolidated Investments, or HCI. For the third successive year, KAL Group, formerly Co-op Agri. A wild card from 2023 is coming back in 2025. Nampak, PPC, the cement company, Rainbow Chickens, and then lastly, Rhodes Foods Group, or RFG. So why did I choose those 10 stocks? I think you will probably see that there are very few small caps in that list. I think the smallest counter is probably CMH with a market value of about 2.2, 2.3 billion rand. Then we got Rainbow Chickens probably at about 3.5, 4 billion rand, but many, and then KAL Group also in about the 3.5 billion rand range. Most of the others are fairly sizable, although Nampak can also be considered a small cap because it's come a long way. But most of them have got a certain degree of liquidity because, again, because my work is tailored towards an institutional audience, I have to be very cognizant of the fact that institutions have very large balance sheets. And if I recommend too many small caps, they often complain that there is a lack of liquidity to buy and sell the counters. So I have to create a list that gives something to everybody. You know, a few wild cards, a few value plays, a few small caps, but predominantly mostly mid caps, which means it's hopefully easier to get in and out, which is something that is quite critical when you're a very large institution. So I'll start off with Advotech. Now, for those that know, I've covered the education sector for decades. In fact, I've covered Advotech for probably 26, 27 years. It's a stock that is trading, when I selected it, at 32 Rand and 80 cents. It is the largest private education company in the country, with very well-known brands like Crawford College, Pinnacle, Advotech Academy, Vega, Varsity College, and Rosebank, amongst others. It is a sizable operation growing in Africa, in Botswana, in Kenya, and latterly in Ethiopia, and we are looking to expand. Now, this company had a change of management about a year ago when an outsider came in called Jeff White, a Scottish guy who was an esteemed international CV, working for some of the world's largest consumer goods companies. And I was a little bit cautious because he has no education expertise. So I had a significant meeting with him when he just got the job to try and ascertain what this gentleman was going to be doing to an education company, because the last few CEOs have all had education backgrounds. The former CEO, Roy Douglas, ran the tertiary operation. The CEO before that, Frank Thompson, ran Advotech for many, many, many years. And there's nothing about schools that you could catch him out on. So as a marketeer coming in to run the education company, I was intrigued what he would do. And for quite a number of months, the market was perplexed as to what Mr. White would do. And then in late November last year, they organized a site visit for institutions and invited analysts, of which I was one. In fact, I was the only, I think, non-broker analyst to go, given my historic coverage of Advotech. And Jeff White laid out the strategic vision for Advotech, which is basically focusing on the mid-level market in this country in terms of education, in terms of the primary and tertiary operation, and very strong growth in education into Africa, where the parents and the price points enable Advotech to extract a much healthier margin, because the cost of teachers is cheaper, the cost of tuition generally in dollars is higher, and they make a significantly better margin. And I think the strategic review which Mr. White gave to the assembled audience, and I urge you all to go on the Advotech website and search the strategic presentation given on the site visit. It's a 70-page document, and all of us walked away from that site visit literally in awe as to how strong this company is, what its distinct strategic strengths and advantages are, and we now know exactly where Jeff White is taking this company. It is growth into Africa and cementing, and galvanizing its very strong footprint in the mid-education market in this country, with a strong focus on the tertiary market with the expansion of Rosebank College and some of its other offerings, given that they expect to gain university status in the next couple of years. And as we all know in this country, despite the fact that a record number of matriculants passed the exam, a pass mark of 30%, quite frankly, to me is not exactly a pass mark. So I think there are many parents out there who wish to send their children to a credible private education institute, be it on a primary, secondary, or tertiary side, so that their children get a decent education. And I think that the likes of an Avitec is extremely well placed, given it has an extremely strong balance sheet, extremely strong cash generation, with the ability to grow and to gear. The Avitec, to me, at 32 Rand 80, is my pick of a pops in education. The ranking currently is number 1 Avitec, number 2 Stadio, and number 3 Kuro. It was number 1 Avitec, it was number 1 Stadio, but that's had a hell of a run, and I've pulled it back. And Avitec to me looks like a very interesting proposition. My number 2 stock is Cashbuilt. I've been very keen on Cashbuilt since the beginning of October. I had a strong buy recommendation at 168 Rand and 170. It got to a recent high of 225. And when I chose a stock, it was 212 Rand and 70 cents. It has dipped below that. But again, this is a 12-month competition, and I'm not going to be too phased in short-term movements in the first 2 weeks of my selection. So why did I choose Cashbuilt? Well, for those that have very long memories, and I've covered Cashbuilt from 3 Rand 53 in May 1996. It got to a peak of 550 Rand and crashed to a low of about 110. In the same period, when COVID came along, everybody ran out and started redecorating and remodeling and refurbishing their houses, and there was massive growth in earnings. When COVID abated and normality returned to the residential DIY and fixer-upper market, the earnings basically tanked. And earnings, having been near to 40 Rand a share, fell to roughly 9 Rand a share. And I think Cashbuilt is now realizing that the halcyon days are not going to come back anytime soon. But with the advent of a two-pot system, which was launched in September last year, freeing up pension funds from pension holders, they rapidly went out and spent that money. Hopefully, some of it went towards the DIY residential and refurb market. And of course, the interest rate sector is rolling over with a couple of interest rate cuts to date, with hopefully more to come in 2025. And the fact that the government of national unity wants to actually start improving the GDP growth of this country, which has been abysmal for years. Many of the levers, which hopefully will prime the pump to consumers feeling slightly better about renovating and refurbishing their houses, will hopefully engender its way back into Cashbuilt, which is the leading national retailer of building materials, not just in the urban, but in the rural areas. So when I chose the stock at 168 Rand to 170, I thought it would get to 200, which it rapidly did. I then thought it would get to 250, and it got to about 225, and then stalled. My ultimate target price for Cashbuilt is about 350 Rand. Will it get there this year? I think not. But I think the touch points on the sector and the ability of Cashbuilt to tie in to a number of areas which could benefit the consumer and ultimately the company, I think are all there. So as I said, I'm carrying on with my buy at 168 Rand, see more runway ahead for earnings and share price recovery. And at 202 Rand, or 212 Rand 70 cents, 202 Rand and 7 cents, I remain fairly confident that by the end of this year, Cashbuilt will be higher than it is right now. My third stock, for dramatic pause, is Combined Motor Holdings, or CMH. For those that don't know the company that well, it was founded in the early 70s by Jeb McIntosh, who is still the majority shareholder and the CEO of the company. He's now in his mid to late 70s. There isn't a sharper, more astute CEO in the motor retailing and logistics sector. He's probably forgotten more than most people have actually known in their entire career. And it pays to be an owner, operator, manager with your foot close to the pedal. So their single largest business is selling brand new cars, mainly in the affordable range. They've got Ford, Nissan, Volkswagen, amongst others, but they are very well known for being the franchisee in this country for the Suzuki brand. And in the NAMSA, which is the new vehicle stats, which came out a couple of days ago, Suzuki is the third best-selling brand in this country after Toyota and Volkswagen, showing you that people want value for money. And even though the Chinese brands, do attract a certain type of consumer, the quality of the Suzuki brand as a Japanese hybrid, even though most of the cars are made in India, has drawn a certain level of interest, and it's been rocketing up the charts. It also has a very large used car business, where as you trade in your car, they sell them through their own business. But the core moneymaker inside CMH is First Car Rental, which is a very interesting tie-in with SAF Air. And during the COVID period, when not many airlines were basically flying or they'd gone bust, like British Airways or Mango or SAA, SAF Air and CMH had a very intriguing link, which is still a very strong link to have. And in the last full year results, 50% of CMH's profits came from its First Car Rental. And as we've seen in the last couple of years, as the country has reopened to offshore tourists, and as the rand has sunk, we have become a magnet for offshore tourism. In fact, I saw today in a recent international poll that Cape Town has beat New York, Melbourne, amongst others, to be the best tourist city destination in the world. So if you've got an inbound car rental business, particularly one with a close affiliation to the country's largest domestic airline, then you are very well placed. And in an environment where interest rates are hopefully rolling over, and we did see the December NAMSA stats at their best level of sales in quite some time, then CMH is ideally placed as a small cap company with a nationwide footprint to benefit from renewed new car sales and inbound tourism. Now, why do I like CMH compared to Motus? Well, again, I cover both companies, but to me, I look at the inherent quality of management, the balance sheet, and the positioning. I think that when the levels of growth return to the new car market, and that'll probably only happen after a couple more interest rate cuts, but given the affordable end of the CMH range with Suzuki, Haval, Chery, amongst others, that they should do quite well. And of course, the inbound tourism market with First Car Rental. They also sit on a very, very healthy cash balance of nearly 700 million rand, which benefited the company in high interest rates environments because they had net earned interest. With interest rates going down, they do lose at the margin because they will not earn as much finance income. Whereas Motus, which is stuffed full of debt, should have a slightly better benefit. But in CMH, have a balance of management, owner management, the cash balance, the conservatism, the affordability of their new car vehicle range, and of course, the car rental business, I think is extremely well placed to grow in the next 12 to 18 months. It would also not be remiss of me to mention the fact, as I indicated at the start of this presentation, that the management, who are majority shareholders, they own about 44% of the company, are all getting on in years. I think the average age of a management team is in the high 60s to mid 70s. And one would have to be, considerate of the fact that no one lives forever. And whilst no one wants ill will in anybody, anybody at some point has to start thinking about estate planning and retirement. And when I see a company like CMH, which has been run by the founding partners since the early 1970s, they're getting on in years, and the company is extremely well placed. and looking at a very interesting value proposition. If you strip out the cash, of a price earnings ratio of CMH is probably around 5 or 6 times, which is hardly demanding given the quality nature of his business. But I would have to think, what price would someone potentially pay to buy this small cap jewel, either from a private equity standpoint or another company? And it certainly isn't going to be 33 Rand and 6 cents. I value CMH at 42 Rand minimum. So if during the course of the next 12 to 18 months, some corporate activity were to occur, should management decide to step down or retire, which perhaps would occur sooner rather than later, then I would think that CMH, in my play of probabilities, because I love playing permutations, it's the nature of what I do. And let's not forget that my call of last year regarding permutation play was Mustec. And Mustec was eventually acquired by Novus, and the share price ran up very, very highly. This year's special situation target is CMH. And I think at 33 Rand, there's some sizable upside in that company, not just from an operational issue from new car sales and inbound car rental, but also for some potential corporate activity. My next stock is Grindrod. Selected at 11 Rand 80, is trading at around that level. The share price for much of last year was riding high. It's been a perpetual buy from this desk since November 2020 at 3 Rand 70, when I had a 7 Rand 50 target and everybody thought that I was smoking my socks. And it's made and exceeded every single target that I have set. 750, 1150, 14 Rand, and latterly 16. And the stock was riding high up until the Mozambican political situation turned violent after the last election, and the borders were closed. Now, for those that know, Grindrod have a very profitable joint venture with Dubai Ports International and the Mozambican government in the port of Maputo and Matola. And they have used their logistics network from this country across the border, both by rail and by truck, to take product into the port of Maputo, because the South African ports, as run by dear old Transnet, have been quite frankly abysmal. And they've made very good money. But with concerns about the political situation in Mozambique spooking the market, even though the underlying corridors continue to operate, the sentiment issue has caused the share price to skid from 15 Rand 50 and has fallen to about 11 Rand 80, which is about a 25% fall. Now, the second that Mozambique starts normalizing its political situation, which might take some time, I think Grindrod will bounce back. Also, what occurred on the 20th of December, I was working over the festive period, so my clients gained this hot piece of news on the 20th via my varying outlets, is that the Transport Minister, Barbara Creecy, promulgated the third-party rail system, which allowed the private sector to use the Transnet railway network. Now, that is going to be some really, really good news for industry, who have been struggling to get their product from the mine or the field to port, and of course for the private party rail operators that could benefit. Now, the only listed player that investors can participate in is currently Grindrod. So as the third-party rail actually starts to roll out, and on my desk behind me, you'll see a stack of newspapers, of which there are numerous headlines about the potential windfall investment that could fall onto the transport system as the rail network starts seeing significant infrastructure investment and the private sector starts gaining traction. So to me, Grindrod is in the sweet spot of owning its own rail operations with locomotives and wagons. Third-party rail has kicked in. It has port operations in Walvis Bay, Namibia. It's got Marion Port in Durban, and it's got the port of Maputo. So it's very well placed from port, rail, logistics. And of course, as the Mozambican situation calms, hopefully the market will see some sense. and results are coming out from memory in early March. And I think we're currently in a vacuum. So there's lots of information going on behind the scenes for those that closely monitor what's going on in the PPPs. But there isn't much of a public domain. It's all in the realms of what I would call those that follow the sector closely. And I think Grindrod is keeping their powder dry. And when results come out in March, I think they will educate the market to the potential strategic realignment of their business towards PPP and the benefits that the company could see from sizable capex from themselves and the benefits that shareholders could accrue in due course as third-party rail and third-party ports starts kicking in. So Grindrod to me looks like an easy win back to at least 16 Rand or 16 Rand 50. I'm going to rattle on quite quickly. HCI, or Hostin's Consolidated Investment, is trading currently at 161 Rand 47 when selected. It is a BEE investment company run by the former Union and MP, Johnny Copeland, who's the CEO. He's currently in his mid-70s. A more astute man you've never come across. The smart money says that where Johnny's money goes, you should generally always follow, because Johnny hates losing his own money. So we've seen in the last period that many of HCI's underlying assets, Southern Sun, Frontier Transport, have done extremely well, and other assets like Soho on the gaming side have not done that well, and as such, the share price has been a bit weak. But the main result of the weakness is the oil situation. Without going into too much detail, although I do cover this extensively in recent notes to clients on the machinations that occurred on the 20th and the 23rd of December when HCI reshuffled many of its assets, and particularly in overnight news with Total Energy and the exploration operations in Namibia. HCI has a 10% stake in one of the most promising new oil explorations the world has seen probably in many, many years, which Total Energy off the coast of Namibia is currently exploring. And they've basically farmed out the cost of production of that well to Total Energy, and in due course they will get a royalty and dividends, but that'll only happen on first oil probably in 2029. So when all this was announced, and I broke the story on Valentine's Day in 2022, and the share price of HCI was about 80 Rand at the time, and it promptly went to about 250, because everybody thought that the oil windfall would lead to HCI selling its stake and shareholders getting a huge cash dividend. That looked like it was on the cards up until early December 2024, and then the CEO changed his mind and said, I think I'll keep the oil. I will let Total Energy pay for all my production costs, and I will happily sit back and collect a fat dollar-based dividend for the next 30 years, which is great for HCI shareholders of a longer run, but many of the short-term investors who bought the stock on an oil windfall didn't see a cash payout, so they sold. So the discount has now gone from a slight premium back to a discount of around 25 to 26%. But I would not bet against Johnny Copeland. I would certainly listen into the Total Energy results, which are coming out, I think, on the 6th or the 7th of February. And as more information is forthcoming on the oil assets, and I think as the market starts to see what Johnny Copeland actually did in December, when all of you were either on holiday or sleeping, they'll start to come to the realization there is value in this business, and the underlying assets also have significant value. So in my mind, at 161 Rand 47, I see value in HCI back into the mid 225 Rand level. So I've put HCI in as a value play for recovery as and when the situation starts to normalize. I'm not going to talk too much on my next stock, KAL Group, which went in at 50 Rand and 50 cents. It was in last year and the year before. It's been a fantastic performer for this portfolio for the last 2 consecutive years. And I think on a P ratio of around 8.5 to 9, it still has value. Even though earnings last year were down 9%, I think that it was a speed wobble rather than a strategic misalignment. And I think that once the management details at the next annual general meeting what the company is proposing to its 2030 strategic review, the market will see that, you know what, last year was a speed wobble and nothing to be too concerned about. And I think as earnings start to recover, and the agricultural sector should do quite well, and of course the recovery in the convenience store, the fuel business, which is very important and key to KAL Group's growth going forward. At 50 Rand and 50 cents, the market will see that the stock is looking cheap as a retailer. And I have a target price on KAL Group ultimately of 64 Rand. Will it get there this year? No, I don't think it won't. But I think it'll easily get towards 58. So I will take that growth plus dividend any day of the week in a year which could see it being far more difficult to make money. Nampak is coming back in at 406 Rand 54, although I'm well aware the stock is trading below that at current levels, but this is a 12-month competition. When I selected Nampak at the beginning of 2023 at an adjusted price of the then rights of 201 Rand 58 cents, the number of criticisms and catcalls that I got from people saying, Clark, you are completely bonkers in choosing this company. It'll never make any money. It'll go bankrupt. What the hell are you doing? But little do they know that I have faith in my recommendations, and particularly when the underlying investment partners that started the whole activism play, which is A2 Investment Partners, supported by very, very large institutions, which bankrolled the billion rand rights issue in 2023. And of course, the esteemed turnaround expertise of Phil Rue, formerly of Pioneer Foods and many other corporate turnarounds. And I was justified. Nampak got to a recent high of 465 Rand and was a stellar performer in my portfolios last year and the year before. But they had a misstep in late November when they came out with a fairly inept trading update, which caused the share price to skid 12% and then cast doubt that the sale of their Nigerian asset, which has been a line in the sand regarding its sale to repay debt and to clean up the structure, perhaps may not occur because the buyer was dragging his feet. That caused the share price to then stumble. So we're now waiting to see if the Nigerian deal will go through and what the update is. But if it doesn't go through, there apparently is plan A and plan B. The bankers are very happy with the performance of Nampak and the restructuring and the debt repayment and the asset sales over the last 12 months. So they're given it significant breathing room. So even though there is a short-term impediment regarding the sentiment impact on Nampak, given the abysmal trading update, which was quickly corrected the next day, the share price rallied. Sentiment is currently against the stock, but I don't really care. I'm looking at a 12 to 18 month view. And if a gun was put to my head, and I am a Nampak shareholder, and I was asked what I think the Nampak share price should be, the answer is simple, 650 Rand. So let's see if it gets there. So I'm banking that Nigeria will eventually sell. The restructuring and operation efficiencies in Nampak will play through. And a bit like my call in 2023, I will again be vindicated by putting Nampak in again as my wild card. Let us see. And while I'm on the subject, I forgot to mention at the start of this presentation, for transparency, it's in the note that I published, which came out recently. I actually own CMH, Grindrod, HCI, KAL, and Nampak in my personal capacity. In every single case, I've owned these stocks for longer than 2 years. In many cases, I've owned them for decades, showing you that my own money is where my mouth is in many cases, and I have no reason not to like the stocks because I'm recommending them and I own them. So to rattle through very quickly the last three, PPC, the cement company, has risen like the phoenix from the ashes. And a bit like my cash flow story, it's a tie-in to growth in the underlying economy. But more importantly, if anybody has not met or engaged with Matthias Cardarelli, the new CEO that took over from Roland van Wyk, who basically steadied the PPC ship from stopping it going bankrupt and doing asset sales like in the DRC amongst other places and Rwanda. Matthias is an extraordinarily talented strategic thinker, and he aims to completely restructure the outlook of PPC to make it make money again. His target is awaking the giant. And I would urge anyone on this call who did not listen in to the last PPC results presentation to listen to it and to look through the presentation. So I am betting that PPC is selected at £4.96, and Cardarelli's leadership will start making money again, seeing its margin improve and getting back to being a proper operational business that actually generates decent returns and dividends for its shareholders. So I am basically backing the new CEO. Sometimes you have to, and that's why I put PPC in. At £4.96, I think the target price on the stock is £8.50. Will it get there? If he does his job, I think it might. Then I put in Rainbow Chickens. Rainbow Chickens was an unbundling from RCL Foods on the 28th of June last year. It opened at about £3.75. It quickly ran to nearly about £6.50, £6.75, and it crashed all the way back down late last year to £3.30. Now, in my normal works, I had a buy on Rainbow at £3.30 and £3.50 towards the end of last year. Astral Foods, the other listed poultry company, as you know, performed extremely well for me last year, gaining about 35%. But many of the underlying fundamentals which benefit Astral also benefit Rainbow. So why didn't Rainbow actually run as Astral ran? Well, that is a very interesting little summation. One, because when they were unbundled from RCL, only 20% of the stock went to institutions. The other 80% went to the majority shareholder, Rembrandt. The institutions that got Rainbow Chickens will have known that Rainbow Chickens for many, many years was a terrible investment. It was a real turkey, and it was the swing factor in RCL's results year in, year out for a combination of reasons, from avian influenza killing the flock, to genetics, which caused the hatchery and production problems. Then we had load shedding leading to fat birds and higher production costs. So for many, many years, Martina Stander, who I've known for probably 10, 15 years, had to fix the farm, which she has successfully done. But investors haven't really seen the benefit of all of that coming through, but they will in the next set of results to December. So I'm anticipating in results to December and June, you will start to see that all the work that Martinez has done over the last 3 or 4 years will start to generate succulent returns from a business which is debt-free, which is the country's second largest chicken producer, producing 4.5 million birds a week compared to Astral's 5.4 million, where the underlying fundamentals are picking up quite nicely in terms of realization per kg of poultry, where there is a scope to potentially get VAT-free chicken. I personally don't think it's going to happen, but if it does happen, it'll be a feather in the cap of the chicken sector. And then the input prices. Now, even though maize is currently very, very high, most of the chicken companies are hedged at lower levels. For the next 2 years, for the next 2 months, my apologies, they're going to have a terrible, terrible time having to procure maize at about 4,500 Rand a ton. But given I cover the soft commodity market extremely closely, if you fast forward, and given we've had late planting because of the late La Nina and late rains, the SAFEX futures market believes that the harvest of 12.7 million tons of last year will rebound this year to over 15 million tons. And they're forecasting the white maize price to fall from about 5,700 Rand a ton to about 4,006, and the yellow maize price, which is predominantly used for animal feed, to fall from about 5,004, 5,005 a ton down to about 4,000 a ton. Now, that is a significant cost saving if the futures market is correct. And with some key data points coming out from the agricultural sector, excuse me, in late January and in late February. If the rains do continue, and there's been some very, very good rains in the key maize belts in the Northwest Province and in the Free State in the last few weeks, if there is confirmation that we're going to get a rebound in the harvest and input prices, which constitute 60% of the input cost of rearing a bird, and we have had load shedding cease, and energy is roughly 25% of rearing a bird, the chicken companies should be in a sweet spot. So then you'll say to me, well, Anthony, if that's the case, why didn't you just stick with Astral? Again, to go back to my initial point, Astral is already up 35% from its low point, which is why I chose it last year at 145 Rand, because it was easy money. I hate recommending stocks when the easy money has been made. The market doesn't like Rainbow, and the institutions that gained Rainbow sold the stock. The ones that wanted to buy it have bought it. So we're now in a really interesting situation. Most of the sellers have gone. All of the buyers that wanted to buy the stock have bought the stock, and there's a very, very tight free float. So they start coming out with some really good earnings and production news. This stock, excuse the pun, could fly. So at 3 Rand 92, when I chose the stock in this selection, I can see the stock going to at least 5 Rand 25. So let's see if my prediction about chickens flying actually plays out in 2025, given it did in 2024. Moving on to my last stock, and in my last 5 minutes, I did say at the start of this presentation that there would be a full-on presentation, and I think the 18 or 19 stocks that I've covered, as well as the assumptions that I've given you as to why I've selected the stocks and my assumptions for the market, all now start to weave a story regarding my top 10. The last counter is Rhodes Foods Group, or commonly known as RFG, run by Peter Hanekom, a gentleman I have known from his days at Pioneer Foods, going back now probably 15 or 20 years. Now, RFG Group, for those of you that don't know the company that well, is a mid-cap food company, market value of just under 4 billion Rand. It has the country's leading jam business, tinned fruit business. It is a major supplier of ready meals into the likes of the Woolworths and the Checkers. And it also has a very nice export business. And it also owns a Bull brand canned meat operation. So it's a very nice positioned food business with many of its categories, even number 1 or number 2. The stock for many, many years, through a combination of acquisitions, which were untimely handled and poorly executed regarding integration, meant that the operating margin of this company could not break the 10% ceiling. Every single year we got fairly mediocre and lackluster results. All of that changed last year. Everything is now turning in the right way. All the divisions are performing extremely well, including the export division. The company had a very good earnings growth last year of 18%. Debt is coming down, and because of that, they increased their dividend by over 100%, even though earnings only went up 18%. The company issued a very, very bullish and confident prospect statement for 2025. And it also, interestingly, a bit like the chicken companies were trying to get VAT-free exemption on their products, the canned meat industry also wants to get VAT exemption for canned meat, because Pilchards, owned by Oceana Group, which owns the Lucky Star brand, does have VAT-free exemption. So the canned meat industry said, well, hang on, if you're giving exemption to canned pilchards, why can't canned meat get VAT-free exemption, which I think is an extremely valid application. So if they do get it, again, it's a feather in the cap for the canned meat industry, and it'll benefit Rhodes. The other interesting tidbit with Rhodes is that Rhodes Foods has a majority shareholder in Capital Works, the private equity company, who owns roughly 38% of the company, a bit like Libstar, my wildcard of last year, where Actis the now American-owned private equity company, also owns 38%. Now, private equity companies tend to have a 7 to 9 year life when they invest in companies. In the case of Libstar and Rhodes, both of those investment timelines start to run out in the next 12 to 18 months. Now, with Libstar and with Rhodes, I'm telling you right now, I am very, very well aware there is significant interest from industry players, private equity players, and other companies for parts or all of Rhodes and Premier and Libstar. So if those respective majority stakes ever get shaken loose by the private equity companies, I think there'd be a significant interest in both companies. But I'm not buying RFG on M&A activity. I'm buying RFG because on a price earnings ratio of 9, with reasonable prospects in the food sector ahead of it, with a strong balance sheet getting stronger, recovery in the export market, and a fairly buoyant prospect statement as indicated by CEO Peter Hanekom, I continue to see, reasonable earnings growth in the next 12 to 18 months. Given the stock reached a high quite a while ago of over about 30 Rand a share, I think got a PE ratio of 9 for what is now a quality mid-cap blue chip food company in the J357 is cheap, or should I say fair. And I would expect a re-rating in due course to maybe an 11 or a 12. And I can easily justify a target price of RFG, probably in the high 20s, if not at 30 Rand. And as such, that's why Rhodes went in. It's a quality mid-cap food company with good prospects. In the last seconds of my 1 hour with Pascal and the kind brokers at Rand Swiss, I'm going to run through once again for top stocks, which are Advotech, Cashbuilt, CMH, Grindrod, HCI, KAL Group, Nampak, PPC, Rainbow Chickens, and Rhodes Food Group. Once again, just to reiterate, I always tell people to do their own research and do not rely on what you listen or hear on a webinar or read on social media or in the magazines that I actually contribute to as a guest editor. Always understand the company that you are buying. But again, all of those companies are, I think, reasonable prospects. And as I said in the middle of this presentation, I own, again, for transparency, combined motor holdings, Grindrod, HCI, KAL, and Nampak. So let's see how this competition rolls out over the course of the next 12 months. I will update, as I always do, the performance of the top 10 at the end of every single calendar month. I always put that performance on my social media page alongside giving it to my institutional clients. So it's all there for the world to see. So nothing is ever hidden away out of view. And on that note, as I'm now over my time, and I'm sure Pascal wants to get home and cook dinner, I'm going to wish all of you participants in this webinar, of which I think over 523 actually registered, a very happy Wednesday evening. Have a look at the notes. It's on the Rand Swiss site if you're a client of theirs. And otherwise, we will keep posted as to the performance. And I'm sure I'll see you again in 3 months to run through how these stocks have performed and further ideas. We've run out of time for questions, but I wanted to get the top stocks done because that's the reason Rand Swiss asked me to do this webinar. And we will get to Q&A at another session. So from me, Anthony Clark, here in Cape Town, I wish you all a very safe and peaceful good evening, and I'll see you again in 3 months.